National Bank of Hungary left the base rate unchanged in September. The decision was no surprise, since it was communicated by the central bank in July and therefore broadly expected. However, the Hungarian monetary framework substantially changed. Now, how has the toolkit of the National Bank of Hungary changed, and what are the implications of the new framework?
Well, up until September, the National Bank's primary instrument was the 2-week deposit facility, and it changed to a 3-month one, capping the 2-week deposit at 1,000 billion forints from January onwards. Now the banks have to comply with the liquidity coverage ratio at 100% from April, next April, so they have to somehow create their liquidity within these conditions. But you have to see that the National Bank decided to cut the interest rate paid on overnight deposits, so the banks are forced to take an additional interest rate risk by purchasing government bonds. So the implications are pretty straightforward in this case, because you should see that the demand for Hungarian bonds increased, so the bond yields should drop to some extent, and in case of market turmoil, Hungarian bond yields should not be hit so hard than we see them before.
Okay, now how does the National Bank of Hungary see the economic outlook, and what is the Monetary Policy Council's main message?
Well, the latest forecast included some changes. Basically, the CPI forecast was slashed to 0% for this year and 1.9% next year. Basically, the NPC said that they do not see the inflation target to be met until the end of 2017. In addition, the GDP forecast was also revised, but the growth rate was not changed. So the growth forecast for this year is 3.2% and for next year's 2.5%. Basically, their message was that they will not increase the base rate until 2017, and at the end of 2017 they will consider raising the interest rate.
Now, Gergi, do you think that the improving big picture implies that Hungary will likely regain investment grade soon?
It's a pretty difficult question. Hungary lost investment grade status in 2011, and since then all 3 major credit rating agencies criticized Hungary because the potential growth outlook remains weak. The economic policy uncertainty makes business climate less encouraging to companies, and also gross public debt to GDP ratio is still high. Fitch and Moody's has the opportunity to review the status of Hungary in November. We think that Fitch might be the first to step ahead and upgrade Hungary back to investment grade, but we think it's more likely to see upgrades coming in 2016.
Gergi, thank you very much for your thoughts.
Thank you.
Dear viewers, thanks for your time. See you around.